Well, certainly the risk is increasing. I mean, the combined levels of sovereign and corporate debts is already at a record high. And indeed, I mean, after a period of 15 years of very low cost borrowing, I mean, the volume of borrowing has expanded significantly and has also expanded into higher risk areas. And now that, interest rates are going up and as, more and more of those bonds issued come to maturity or have to be refinanced, obviously the borrowing costs, debt servicing costs are going up at a time when fiscal capacity or capacity to pay is under strain.
This definitely started around that 2019-2020 timeframe, right? And I mean, that will be COVID-19. Can we still blame the pandemic for these record numbers?
Well, there's no question that during the pandemic, governments around the world had to significantly boost their level of expenditure in order to support households and support business and the economy through what was a very challenging period. But when you look at the corporate bond market, over that period, I mean, there has been a very significant expansion of the level of debt issued, and indeed there has been a significant expansion of the level of debt issued into riskier segments of the market. And that can't be blamed on the pandemic. I mean, that is essentially these are other factors.
Yeah, a lot of this debt as well, sir, is to the emerging market nations, those developing nations. And one could say that recent calls to scrap parts of this debt would have possibly helped the situation. What's the feasibility, though, of either scrapping part of or the whole debt, or even maybe just restructuring?
Well, I mean, clearly we will need sound debt management. We will need, obviously appropriate and well-targeted fiscal policy. And it's also appropriate to have international conversations about how some of that can be supported, how some of the developing economies and some of the more vulnerable economies in particular can be supported by advanced economies. But, there's no question that the current environment is putting emerging market economies and developing economies under particular levels of pressure as their fiscal capacity is reduced at a time when their financing needs are increasing. And of course, borrowing costs and debt servicing costs are on the up.
Yeah, I mean, that's certainly going to hurt. We're showing a graph, though, now where we had showed it a moment ago, but it's really just with regards to central banks having taken on a lot more bonds, especially since COVID, as we've been speaking. But that is beginning to actually come off. Are there any kind of concessions being made to try and move the needle? Because it feels like the more developed nations will have to take on the brunt of this global debt in some way, and yet they've been the countries that have been able to hold on to debt for a little bit longer than some of the others. Are there concessions being made to move the needle? Well, I mean, what happened during, in the context of the pandemic was a very deliberate approach by central banks to bring down the cost of, borrowing, including and in particular by reducing, longer-term yield curves. And so, I mean, that was, but now, I mean, that quantitative easing has come to an end. I mean, monetary policy is becoming, has rapidly tightened, and so central banks are withdrawing from that part of the market. I mean, as part of a shift to monetary policy tightening. So now, when it comes, I mean, when it comes to who takes over that proportion of the market, I mean, as yields go up, as the level of income generated goes up, you will see more investors coming into this market, taking over the position that was previously held by the central banks. Yeah, but they don't go in when you get a sense of austerity happening in a lot of these economies, would it, sir? Is that not a risk? Well, certainly emerging market, I mean, there are risks. Emerging market and developing economies will need to apply sound debt management practices and will focus on boosting their fiscal capacity, including and in particular by focusing on, growth-friendly, productivity-enhancing, growth-enhancing reforms.